Congressional Democratic leaders, Senator Ron Wyden of Oregon, left Representative Richard E. Neal of Massachusetts, Representative Nancy Pelosi of California and Senator Chuck Schumer of New York, on Thursday in Washington. Al Drago for The New York Times, Washington. Even some House Republicans are railing against the proposed changes to deductions for state and local taxes that are part of the new House tax bill that was released this week. The proposal to change the state and local tax deduction, commonly known as SALT, has also ignited a backlash from Democrats and state governments. Conservatives call the deduction a boon for high-tax liberal-leaning states at the expense of low-tax conservative-leaning states, while Democrats said its elimination will hurt middle-class families. Here's an assessment. Saying Indiana subsidizes New York through the deduction ignores net revenue and spending. President Trump, in an October interview with Fox News, characterized the state and local tax deduction as unfair, and argued that states like California and New York really are being subsidized by states like Indiana and Iowa, a point echoed by many Republican lawmakers and commentators this week. Under current law, taxpayers can deduct their state and local property taxes, as well as state income tax as a sales tax. The proposed House bill would eliminate the deduction for income and sales taxes, and would cap the deduction for property taxes. It's true that the deduction is an indirect federal subsidy to state and local governments, and allows jurisdictions that impose high taxes to export a portion of their tax burden to the rest of the nation, according to the Tax Policy Center. But deductible state and local tax is just one type of federal assistance, and states that benefit the most from the provision actually rely less on Washington overall. The deduction is claimed by taxpayers in every state, though larger percentages of taxpayers in the Northeast and the West benefit from it. About 46% of tax returns in Maryland, the state with the highest share in the country, used the provision and averaged almost $13,000 each in deductions in 2015, an analysis by the Government Finance Officers Association shows. On the other end, only 17% of tax returns in South Dakota took advantage of the provision, and averaged $6,000 each in deductions. Taxpayers in two states, California and New York, claimed more than 32% of the total deduction in 2013, the Tax Policy Center estimated. This alone does not mean that Indiana is bankrolling New York. Larger states, like New York and California, getting bigger subsist through the state and local tax deduction because they're paying substantially more in federal taxes, said Kim Rubin, an author of the Tax Policy Center report. Multiple studies show that most states that are considered to be a net donor, those that pay more in taxes than they get back from Washington, also benefit the most from the state and local tax deduction. New York State's Comptroller, in an October report, found that 13 states, including New York and California but not Indiana or Iowa, paid more in federal taxes than they received in federal spending in the 2016 fiscal year. In 9 of those states, all of which voted for Hillary Clinton over Mr. Trump in the 2016 presidential election, at least 30% of tax returns claimed the state and local tax deduction. New Jersey, where more than 40% of taxpayers took the deduction, experienced the largest deficit per capita. It contributed about $13,000 per person in federal taxes, but received just $10,000 per person in federal spending. New York had the largest overall deficit, $41 billion. In a similar report, the Rockefeller Institute of Government found 13 net donor states in the 2015 fiscal year. In all but 3 of those states, more than 30% of taxpayers claimed the deductions. Repealing the deduction will affect more affluent than middle-class Americans. Representative Nancy Pelosi of California, the House Democratic leader, said on Thursday that dismantling the state and local tax deduction would be devastating for middle-class families, and several members of her caucus have issued similar warnings. About 30% of all taxpayers claimed the deduction across all income levels, but higher-income households are more likely to claim it. Taxpayers deducted more than $550 billion in state and local taxes in 2015, according to the Government Finance Officers Association, 75% of which was claimed by people with incomes over $100,000. The Joint Committee on Taxation found that tax expenditures, or lost revenue, for the deduction amounted to $60 billion. Two-thirds of that, or about $40 billion, was accrued by tax returns claiming incomes over $200,000, roughly the top 20% of households. About 3.5%, or $2 billion, flowed to the bottom 60% of households. The Tax Policy Center estimates that only 11% of taxpayers with incomes under $50,000 claimed the deduction, compared with 82% of filers with incomes over $100,000. Repealing the deduction altogether would raise taxes on everyone, but taxpayers with incomes over $100,000 would bear the brunt, over 90%, of the tax hike. It's worth noting, however, that the definition of middle class is relative and can range drastically by geography. In Pelosi's district, for example, the median household income was $106,000 last year, which is almost twice as high as the nationwide median. So the households in San Francisco that claimed the deduction and are considered affluent against a national distribution might be considered middle class in their own city. Other provisions in the Republican tax plan shield middle-class families from the effect of eliminating state income tax and sales tax deductions and capping property tax deductions. Taxpayers can claim the deductions only if they choose to itemize instead of taking a standard deduction. Because the Republican plan also proposes to double the standard deduction, fewer people will benefit from itemizing, and many in the middle class will stop itemizing altogether. Drive. Rubin said, middle-class families may feel a less direct effect on eliminating the deduction than what most Pelosi and Democrats are suggesting. Repealing the deductions will make it harder for states to make money and, as a result, it will be more difficult for states to be able to provide services and a social safety net. Drive. Rubin said.